Hello everyone, I am Ravi and today we are going to learn capital budgeting techniques. So first of all we will learn what is capital budgeting. So capital budgeting is related to the allocation of funds to different long-term assets. Now what does it mean? Suppose that the company has two plant proposals. First is plant A and second is plant B. Now how can the firm can decide that in which plant the company should invest, either in plant A or in plant B? Now, for that, there should be some basic techniques or methods on the basis of which the company or the finance manager of the company can decide that in which plant the company should invest. Because capital budgeting techniques is related to the investments, so capital budgeting is also known as investment decisions. Basically, you can say that the capital budgeting techniques assist the finance manager of the company that in which project the company should invest to gain the maximum returns or maximum wealth to the shareholders of the company. Next, we will learn that how many methods are there in capital budgeting. So, as you can see that there are five basic methods in capital budgeting techniques. First is payback method. Second is average rate of return, which is also known as ARR. Third is discounted payback method. Fourth is net present value. And the fifth is internal rate of return. Now the first two methods is related to the traditional approach, while the latter three methods are related to modern approach. Now, what is the difference between traditional approach and modern approach? The difference is so simple that the traditional approach ignores time value of money while modern approach cares the time value of money. Now, what is time value of money? Let's discuss about time value of money. So, time value of money, you can say that time value of money says that the money received today is different in its worth from the money receivable at the future date. And it's true. For that, suppose I have 60 rupees now and I go to market and buy 6 pen of rupees 10 per pen. So I have in total 6 pens. Now, after 1 year, I also have same amount of money, 60 rupees. Now I go to market and now I can purchase only 4 pens of 60 rupees. Why? Because the price of per pen has increased to 15 rupees per pen. Because the pen price is now 15 rupees per pen, I will be able to buy only 4 pens of 60 rupees. So this is called time value of money. Because the money depreciated every time. Because the inflation is increasing, not decreasing always. So that's why time value of money says that the money received today is more valuable than the money received at the future date. Now, we will learn how to calculate present value after the future amount that we will receive after some year. Time value of money says you need to calculate present value of the future amount. So this is the formula that we can calculate present value of the future amount. Here PV stands for present value, A stands for future amount, and R stands for inflation rate, and N stands for number of years. So our formula is PV is equals to A divided by 1 plus R divided by 100 whole is to the power N. Let's learn this formula with an example. Suppose A will receive 10,000 rupees at the end of third year. Now, what would be its value today if inflation rate is 10% per annum? Because our inflation rate is 10% per annum, so we will use this formula because we have future amount 10,000 rupees and we want to find out present value. So PV is equal to 10,000 because A is 10,000 rupees because we will receive it after 30 divided by 1 plus R. R is 10% because our inflation rate is 10%. Now divide by 100 and whole is to the power n, and n is 3 because number of years is 3 years. Now we will get the answer is 7,513 rupees and 15 paise. So this is the present value of 10,000 rupees that we will receive at the end of 30. So that's why you can now understand that the money we will receive at future date will not be at same value of today. The 10,000 rupees of third year is lesser than the today's value, that is 7,513 rupees. So this is time value. Now we will back to our methods. The first two methods ignores time value of money as I have told you, and the latter three methods cares about time value of money. In this video, we will only discuss about payback method, and coming video we will discuss average rate of return. Then we will discuss all these methods one by one, but in this video we will discuss only payback method to keep this video short. So let's now learn what is payback method. Actually, a payback represents the length of time it takes a company to recover the initial investments in the project. What does it mean? For that, suppose I have 50,000 rupees and I want to invest my money somewhere. So what would be the first question that would come in my mind is that in how much time I will be able to recover my amount. The soon I will be able to my amount to recover my amount, my 50,000 rupees, the more better or good for me. So the payback method calculate the length of time that a project takes to give you your amount that you have invested in that project. So through payback method, you can find the length of time that a project is going to take to give you your initial investment amount that you are going to invest in that project. So payback period you can calculate with this formula. So for that, payback period is equal to number of years immediately preceding the year of final recovery plus balance amount to be recovered in the year of final recovery divided by cash inflow in the year of final recovery. I will explain you this formula with an example. So I have a question for you, and the question says that Mr. A invests in a project with initial investment amount of 40,000 rupees. So here A invested 40,000 rupees somewhere, and in that return, expected cash inflows after tax are 10,000 rupees. It means that in the first year, Mr. A received 10,000 rupees in returns of 40,000 rupees. Suppose in the beginning I invest 40,000 rupees somewhere, and in that return after 1 year I will receive 10,000 rupees. In the second year I will receive 12,000 rupees. In the third year I will receive 10,000 rupees, and similarly in the fourth year I will receive 7,000 rupees, and the fifth year I will receive 5,000 rupees. So this is all cash inflows that I will get one by 1 years after investing 40,000 rupees in a project. So how can I calculate the length of time that this project will take to give me my recovery amount or say my investment amount? So let's calculate payback period for that to calculate the length of time. So in these are the number of years and these are the cash inflows that is mentioned in our question. That in the first year we will receive 10,000 rupees, and in the second year we will receive 12,000 rupees. Third year 10,000, fourth year 7,000, and the fifth year is 5,000 rupees. Now how to calculate payback period? So the formula is we have is in the above, that payback period is equal to number of years divided by balance amount to be recovered and divided by cash inflows in the year of final recovery. To use this formula, first of all we will calculate cumulative amount. What is cumulative amount? The cumulative amount means total amount received. Total amount received. In the first year I have received 10,000 rupees. So my cumulative amount would be 10,000 rupees because I haven't received anything before the first year. I'm receiving 10,000 rupees as my first payment. So my cumulative amount would be 10,000 rupees. So I have write 10,000 rupees in my cumulative amount. In the second year, I have received 12,000 rupees. In the second year, I have received 12,000 rupees, while in the first year, I have received 10,000 rupees. So in total, I have now 22,000 rupees. How? 10 plus 12,000. So in total, I have received 22,000 rupees yet. So I will write 22,000 rupees in cumulative amount in the second year. In the third year, I have received 10,000 rupees, while till in second year, I have received total 22,000 rupees. So in total, in the third year, I have received 32,000 rupees. How? 22,000 plus 10,000. So in total is 32,000. Now in the fourth year, I have received 7,000 rupees as a cash inflow, while till the third year, I have received 32,000 rupees. So in the fourth year, our cumulative amount is 39,000 rupees. How? 32,000 rupees plus 7,000. The cumulative amount of till the fourth year is 39,000 rupees. In the fifth year, I have received 5,000 rupees as the cash inflow. So my cumulative amount would be 44,000 rupees. How? Simple, 39,000 plus 5,000 is 44,000. So this is all is the cumulative amount, and these are the cash inflows. So first of all, for payback period, I will calculate the cumulative amount. Now I can use this payback period formula. So in this formula, the first says that I need number of years that is immediately preceding the year of final recovery. What does it mean? In how much amount I have invested in a project. I have invested 40,000 rupees. I have invested 40,000 rupees. So you can say here that in the till the first year I have received 10,000 rupees, second year 22, third year 32,000 rupees, and in the fourth year in total I have received 39,000 rupees. While I invested 40,000 rupees, and in the fifth year in total I have received 44,000 rupees. Means 4,000 rupees extra I have earned till fifth year in return of 40,000 rupees that I have invested in the project. So my recovery amount or my payback period would be between fourth year and fifth year, because I'm getting more money in the fifth year that I have invested in the project. I am getting 4,000 rupees extra in the fifth year. While in the fourth year, there is a 1,000 rupees less that I am earning, that is 39,000 rupees. So my payback period should be between the fourth and fifth year. Suppose my payback period is 4.5 years. For suppose, assume that my payback period is 4.5 years. So if my payback period is 4.5 years, so the first formula says that I need number of years that is immediately preceding the year of final recovery. Suppose my year of final recovery is 4.5. So what is the number of years that is immediately preceding the year of final recovery? The year that comes before 4.5 is 4 years. So I will write 4 instead of this. So write 4. Because 4 is the year that is immediately preceding the year of final recovery, and the year of final recovery I have assumed is 4.5. Because I know that my final recovery would be between 4 and 5th year. So you can assume any payback period between 4 and 5. You can assume 4.6 or 4.8 or 4.9. You don't need to write it somewhere. Just assume that the payback period would be 4 and 5, because I am getting in the 5th year 4,000 rupees extra, while in the 4th year I am receiving 1,000 rupees less. That the amount I have invested in the project. So my payback period should be between 4th and 5th year. So I can assume any period between 4th and 5th year, and I assume for my comfortability 4.5. So the number of years immediately preceding the year of final recovery is 4. Now you need to plus the balance amount to be recovered in the year of final recovery, that is 1,000. How? Because the final I have assumed 4, and in this fourth year I'm getting how much amount is 39,000, while I need to get 40,000 rupees because I have invested 40,000 rupees in the project. So I'm getting 1,000 rupees less. So my balance amount is 1,000 rupees. I hope you are understanding that my balance amount is 1,000 because I have invested 40,000 rupees while I'm getting 39,000 rupees. So my balance amount would be 1,000 rupees. Now you need to divide the cash inflow in the year of final recovery. What is the cash inflow? You need to go to cash inflow column. What is our cash inflow column? Our cash inflow column is second column. This is our cash inflow column. So in the cash inflow column, you need to find out the cash inflow in the year of final recovery. Our final recovery period would be here 5th. So cash inflow in the year of final recovery, because our investment period is 5th. So in the last year, final recovery here means the last year. So in the last year, I'm getting 5,000 rupees. So you need to divide 1,000 rupees by 5,000 rupees. So here I have write 5,000 rupees in the division column of 1,000. Because cash inflow in the final year of recovery is 5,000 rupees. Now simply solve it. You will get 4 plus 0.2 is equal to 4.2 years. So this is our payback period, that in the 4.2 years you will be able to recover your amount that you have invested in the project. So our payback period is 4.2 years. So let's now learn another question for payback period for more clear information. So here I have another question of payback period. In this question we have that a company is considering an investment including the cost of 50,000 rupees. The facility has a life expectancy of 5 years and no salvage value. The company tax rate is 35%. The profit before depreciation are as follows. So this are the cash inflows. In the first year is 10,000, in the second is 11,000, in the third is 14,000, in the fourth year is 15, and the fifth year is 25,000 rupees. So one by 1 year we are receiving this cash, we are receiving this profits amount. Careful, this is profits, not cash inflows. Actually, we need cash flow after tax for calculation of payback period, not only profit. These are the profits, so we cannot directly calculate payback period because we need cash flows after tax. So, what is the difference between profit and cash flow after tax? In the last question, if you remember, we had cash flow after tax, not profit. Let me show you that in the last question. Here, in the last question, we have cash inflows after tax. These are the cash inflows after tax, not the profit. That's why we calculated payback period directly by using this formula. But now, as you can see that I have solved this here. Now we have profits, not cash inflow after tax. So for payback period, we need cash flow after tax. Always remember, we need cash flow after tax, not only profit. These are the profits. So let me explain you what is the difference between profit and cash inflow after tax. So let's learn the difference. Actually, suppose we have a profit as given in this question, we have profits. For calculation of cash flow after tax, first of all, what do? We deduct depreciation out of profit. So first of all, we will less depreciation out of profit. Then we will receive profit before tax. This amount, after deducting depreciation out of profit, we will receive profit before tax. And this amount is known as taxable income. This is our taxable income that we will receive after deducting depreciation. Now, after getting profit before tax, we deduct tax amount or tax rate. Because our taxable income, this is our taxable income, so we less our tax after taxable income. So after deducting tax, we will receive profit after tax. So this amount is profit after tax. How do we get profit after tax? By less or deduct tax out of profit before tax, we get profit after tax. Now, to calculate cash flow after tax, what do? Actually, we again add depreciation in profit after tax to get cash flow after tax. Why do we add depreciation again when we have deducted here? Actually, you have to understand that depreciation is a non-cash expense. It is not an actual expense. Depreciation is just a non-cash expense that we calculate on our machinery to get the fair value at the end of each year. So depreciation is a non-cash expense and we actually do not pay anything to anyone in depreciation. So it does not include any cash outflow. Depreciation does not include any cash outflow. That's why our cash flow after tax, to get cash flow after tax, we again add depreciation. After adding depreciation, we get cash flow after tax, and this is required for calculation for payback period. Actually, in this question, we have profits directly. So we cannot calculate payback period directly because we have profits while we need cash flow after tax. So we'll solve this question with after doing this all methods. So first of all, we will deduct depreciation, then we will deduct tax. After that, we'll add depreciation, then we will receive cash flow after tax. That is what required for calculation of payback period. So let's solve this question. In this question, our outflow is 50,000 rupees. Let me show you the question again. This is our question that our investment is 50,000 rupees and this is our profits in each year. These are the profits, not cash flows. So first of all, we'll need to calculate cash flow after tax. So let's solve it. Here I have written down that in each year, first column is of years 1, 2, 3, 4, 5. Next column is of profits 10,000, 11, 14, 15 and 25. Next, in the next column, I will deduct depreciation as I have told you before. That first of all, we deduct depreciation out of profit. So write depreciation Now, do we know what is the rate of depreciation? Let's solve the question again. So in this question, the rate of depreciation is not mentioned, but it is mentioned that the company use SLM method for depreciation. What is the SLM method? SLM method is straight line method. Because company use SLM method, we can find depreciation by the formula of cost minus scrap divided by number of years. I hope you know this formula already, that we can calculate the depreciation if the depreciation method is SLM by cost minus scrap divided by number of years. We have cost of 50,000 rupees and the N is 5 years, but we don't have any salvage value. So to get depreciation, what do? We'll divide 50,000 rupees by 5 to get depreciation. So here, right, is equals to 50,000 rupees divided by 5. We'll get the depreciation amount, that is 10,000 rupees. Actually, you can solve the same question in your notebook by the same method that I'm doing in Excel. I'm just doing in Excel to get calculation fast. But the same method you will adopt while calculating payback period in your notebook. So because we are doing SLM method, so our depreciation would be same in each year. So I'm just dragging this depreciation amount. So our depreciation is 10,000 rupees in each year. Now what do? We'll deduct depreciation out of profit to get profit before tax. So profit before tax. Now deduct depreciation out of profit. So select this cell minus this cell. We just need to deduct profit out of depreciation. So it will be 0 because 10 minus 10 is 0. Now I'm dragging it and the number of profit before tax will be same. Now after that, after getting profit before tax, what do we actually need to do? We just, because profit before tax is our taxable income, so we'll calculate tax amount here. So first here we'll calculate tax amount. Do we know what is our tax rate? Let's solve the question again. Yes, we know tax rate. The tax rate is 35%. So the tax rate is 35% at the rate 35%. So is equals to profit before tax multiply by 35%, 0.35. Enter. Now just drag it to calculate tax amount. Now to get profit after tax, I will deduct tax out of profit before tax. To get profit after tax, profit after tax. So is equals to this minus this. Simple. It comes profit after tax. Now I'm dragging it, and this is our profit after tax. Now what do? We again add depreciation because depreciation is a non-cash expense to get cash flow after tax. So write cash flow after tax. Let me adjust. So here to get cash flow after tax, again add depreciation in profit after tax. So select this plus add depreciation. Depreciation is our 10,000. So add, again I am doing is equals to profit after tax plus depreciation. And you need to do this again and again. I'm just dragging it for simple calculation. So now I have cash flow after tax, and that I need to calculate payback period. So now I have cash flow after tax after adding depreciation again in profit after tax. Now what do we need to do? I hope you remember. Now I have to calculate cumulative cash flow. After getting cash flow after tax, I need to calculate cumulative cash flow that we have already done in the previous question. So write cumulative cash flow. So Now we will calculate cumulative cash flows. Our first 10,000 rupees would be saved in the first year because this is our first return in the first year. In the second year, in total, I will receive 10,000 rupees plus the second year amount, that is 10,615 rupees. In the third year, I will receive 12,600 rupees, but in total, I will receive 12,600 rupees plus 20,650 rupees. Similarly, in the fourth year, I will receive 13,250, but in total, I will receive, after adding this, is 46,500 rupees. And in the last year, I will receive 19,750 rupees plus the cumulative cash flow amount. So here now I have calculated cumulative cash flows. So till now we have calculated cumulative cash flows. Now we will calculate payback period. The payback period formula is, we know that number of years immediately preceding the year of final recovery plus balance amount to be recovered in the year of final recovery divided by cash inflow in the last year of final recovery. So the number of years that is immediately preceding the year of final recovery is, our outflow is 50,000 rupees. Our investment amount is 50,000 rupees. So in the fourth year, I am receiving 46,500, while in the fifth year, I am receiving 66,250 rupees. So my year of final recovery should be between fourth year and fifth year. So you can assume any payback period between fourth and fifth year to calculate payback period, because our 50,000 rupees lies between these two amounts. So I can assume any payback period between fourth year and fifth year. For my comfortability, I am assuming 4.6 years. Let's assume now 4.6. You can assume anything like 4.2, 4.4. So if I assume 4.6, so what is the number of years that is immediately preceding that year of final recovery? What is the number of years that comes before 4.6? The year it comes is 4, because the year that comes before the 4.6 is 4. So I will write 4 instead of this number of years. Now plus, what is the balance amount that you need to be recovered till yet after assuming fourth year? In the fourth year, I am receiving 46,500, while I need to receive 50,000 rupees. So after deducting for 50,000, after deducting 46,500 out of 50,000, the rest amount would be 3,500 that I still need to be recovered. That I will recover in the fifth year. So my balance amount would be 3,500 rupees. I hope you have understood why 3,500, because this is the balance amount to be recovered that I will recover in the next year, in the next coming year, because in the fourth year I am receiving only 46,500 rupees. I still need to be recovered 3,500. So the amount that you still need to be recovered, you will write here. So now next is cash inflow in the last year of final recovery. So where is our cash inflow column? G column is our cash inflow column. So in the last year of final recovery means in the last year, our period of investment is total 5 years. Let me show you that our total life of our investment is only 5 years. 1, 2, 3, 4, 5. The last year is 5 years. So what is the cash inflow in the last year? It means the last line that is in our formula says the cash inflow in the last year of recovery. So in the last year of recovery is 19,750 rupees. So divided by 19,750 rupees, I will get my payback period. So 4.177 to 15. Let's round off it. So our payback period is 4.18. So I hope you have understood this question, that in this question we had profit, and because we cannot calculate payback period through profit, so that's why I calculated cash flow after tax through this method. Like first of all deduct depreciation, then tax, then add depreciation again, then you get cash flow after tax. So I follow the whole processor, that I get cash flow after tax, then again I calculate cumulative cash flows, then I use this formula of number of years and balance amount and cash inflow. Then I get 4.18 years. This is our payback period, and this is all for this video. In the next video, we will learn average rate of return.